Chapter 2's fifth objective is to prepare the trial balance from the T accounts. Trial balance. This is a summary of the ledger. It lists all of the accounts with their balance, and it's an accuracy check. So at the end of the period, before we prepare financial statements, we want to make sure that the books are in balance. So we list out all of the accounts with their debit or credit balances. We add up each debit, all the debits and all the credits, to make sure that those two amounts are equal to each other. Now, it's important to remember what this is. This is a device that accountants use just to make sure they're in balance before proceeding into more complex work like doing the financial statements. Again, it's an accuracy check. Not a balance sheet, not an income statement, not a statement of owner's equity. It's a trial balance. Locating trial balance errors. Well, if you're not in balance, what you do is you search for the missing amount, the difference between the debits and the credits. If there's nothing missing, what you do is you divide the difference between the debits and the credits by 2. Is there a debit or a credit balance for this amount posted in the wrong column? Okay, if yes, great, you found the difference. If not, if you can't solve it by this method, then try to divide out of balance amount by 9. It could be a slide, which results from either adding or dropping a 0, like 100 instead of 1,000, or it could be a transposition by inverting 2 digits, like 459 versus 495. When you switch 2 digits around, that's known as a transposition. Okay, the journal details. Okay, you know we've got the date of the transaction, we've got the accounts that are being debited and credited. The posting reference located up here refers to after the ledger's been updated, we record the account number that this $1,000 was placed into. Okay, and then we credit the capital account and also put the amount of the posting reference there. So once the ledger's been updated, you'll see it looks something similar to our T accounts from earlier. You've got the date, the journal reference, the amount. You've got the credit that's being recorded as well. Another example of a ledger account is, you've seen the T accounts in here, is what we use in class, but in the real world you'll see something like the 4-column account. You've got the date on the left, the journal reference, that's the journal page where these amounts came from. Debit goes in the first column, and the balance is extended over to the balance column. It's called a 4-column because 1, 2, 3, 4 columns are there. Then we have the credit from April the 3rd. That reduces the balance to 11,000. We've got a debit on April the 5th. It increases it. The 10,000 on the 6th reduces the 4,000. So a 4-column ledger is more common in practice than, say, a T account. Okay, so that's why the 4-column account is presented here as an alternative to the T account. And that is the end of Chapter 2. And you should refer to your assignments in Blackboard and my accounting lab for the requirements.